What's going on, everybody? So today's video, we are going to be talking about adjustable rate mortgages. A lot of people think they're confusing, think they're risky. So we're just going to break it down in like simple, easy to understand type terms. I have Alex Narcini with me, my top lender. So we're just going to go over all the questions. If you have questions, drop them in the comment section below. And let's jump into it. What's going on, Alex?
Hey, how you doing? Good to be here.
Pretty good. Pretty good. So, okay. So tell me, what is the difference between an adjustable rate mortgage and a fixed rate mortgage?
Yeah, so the adjustable rate mortgage just stands for, we call them ARMs, but adjustable rate mortgage is fixed for either typically 5, 7, or 10-year periods, and then it can adjust. We'll kind of go into detail about how it can adjust, how high it can go. It really just depends on the product as we go further into the podcast. But the 30-year fixed, everyone's heard of a 30-year mortgage. That's the most common. That just means the rate's fixed for the entire 30 years. And then there's also like 15 and 20-year fixed products out there. And they're not as popular, but they're definitely products that are pretty common in terms of like the fixed rate period.
And if you're looking at buying a house, even if you don't even know what an adjustable rate mortgage is, you should ask your lender, like ask Alex, just look at the different options, because you might not even be aware that there's a better, maybe fixed rate is better, maybe adjustable rate's better. We'll talk about which one is better for who, but you should always look at like several options. I mean, you shouldn't just go with like just one thing, because you never know if it might be better.
100%. A lot of lenders, some lenders, like we still do offer really competitive ARM rates, but I was blowing people out of the water because our ARMs, with our company were much lower than others. So, if you're looking at ARMs and let's say the lender you're talking to doesn't offer anything all that competitive, I would say just talk to a couple other people, just get an idea of what's out there. Because right now ARMs are very popular with how high interest rates are.
Okay. And that's what I was going to kind of get into. Like, why would somebody basically do an ARM over a fixed rate mortgage?
Yeah. So, I mean, there's a few scenarios like right now. So I just went through my pipeline before this call just to figure out what percentage of deals were ARMs this year. Cause it was like a lot higher than I've ever seen, I've ever done. And I've been doing this for 11 years. So this year, 70% of my deals have been adjustable rate mortgages. And typically it's like 10%. Like if I'm like looking at like 2020, 2021, no one was doing ARMs really. I mean, it's very rare. So a situation that I trying to like right now is a really odd time in the market. So right now, 30-year fixed rates are 20-year highs, right? So if you're considering an ARM, usually the rate can be like maybe 1.5% lower than the 30-year fixed rate. So if someone thinks like either they're going to own the house for a shorter period of time, maybe it's their first house, maybe 5, 7, 10 years, then I would say you probably want to consider an ARM. Sometimes I have to kind of just coach them through it because most people think it is a little bit risky of a product. But also what I tell people is, look, the odds of rates being lower than they are right now in the next 5 or 7 years it's pretty high. I mean, I think like most economists are saying rates are going to come down in the next year or two. So typically rates, every recession, you'll see lower rates and then you can always refinance out of the ARM into a fixed rate at that point. So that's kind of like my sales pitch. And I'm not trying to push people in ARM. I just give them the options, the information, and they just make their decision. And most people, if they qualify for ARMs, they're going with ARMs.
So it's good for someone that, it's going to, just to like recap, good for kind of like a starter home. If you might not live there for a long time, good in a high interest rate environment like it is right now, where, 3, 4, 5, 10 years from now, the interest rates likely will be lower.
Exactly. And, usually like the difference between an ARM and a fixed rate, like for example, last year was only maybe like 0.25% or 0.5%, where right now ARMs can be an entire 1% or 1.5% lower than the 30-year fix. So when you have a spread that wide and the state, like for example, I just pulled up an example earlier today. So I closed this loan last month, right? My 5-year ARM was at 4.875 versus a 30-year fixed at 6.25. So I gave them the options. They were going to save over $700 a month, right? Going with the 5-year ARM. So that ended up over a 5-year period. That ends up being like $42,000.
Mhm.
Their plan was they're probably going to own it for longer than 5 years, but they think they can refinance out of it once rates drop back down. So that was kind of like the reason why they wanted to go with an arm in that
Yeah.
scenario. But
Okay.
that's really common right now where people think they're going to own it longer than 5 or 7 years, but they still go with the arm just because they think they can refinance, which I think is a pretty
Okay.
high probability, but nothing's a
Yeah.
guarantee. So there is a little risk there.
Yeah. So if the difference between the arm and the fixed rate is pretty close, then you probably go with the fixed rate. But if there's a significant difference, like you're saving 700 a month, it could make sense to go with the arm. And it's that's true with like refinancing too. You could probably speak on this. Um, if you're refinancing, right, you usually want it to be like a 1% difference, right? That's what I've always heard
Yeah,
as
I
an
mean,
agent and investor. I mean, you want to save money, a lot of money each month, but I've heard
yeah.
1% is like a good rule of thumb.
Yeah, 1% to refinance. I mean, that's great, but even 0.5% can make sense. It just depends on like the break even.
Okay.
Refinancing, I say 0.5% or more, but
Mhm.
1%. I mean, I mean, 100% do 1% or lower. I mean, that's amazing
Yeah.
if you can
That
refinance that.
I think that's what you did with mine. I had a 3.6 and then I basically went to like a 2.6, which was like, you know,
It's free
saying
money
that
right
now,
there,
yeah.
basically, right?
Yeah.
Yeah.
Saying that now is pretty crazy. Oh, another thing I wanted to add is if the mortgage, if it's like a lower price house, like under 200,000, the difference, even if it's like a much higher percent, the difference between an adjustable rate and a fixed rate mortgage, it might only be like $100 per month. So oftentimes I've heard it's better, if it's a lower price property, just go with the fixed rate, just because you're not really going to be saving like too much on that.
Yeah, I mean, it really depends on the situation. If someone's pretty confident they're only going to live there, maybe they're in the military, they're only going to live there for 5 years or something like
Mhm.
that. Then go with an arm. But if you have no idea, then I would say that makes sense. If it's only $100
Yeah.
difference, just go with a 30-year fix at that point.
Yeah, exactly. And so yeah, once you get over 200,000, once you get into like much higher price points, the arm can really, you can really save a significant amount. When should somebody not get an adjustable rate mortgage? I mean, I was gonna say basically when rates are super low, like you said, in 2020, people weren't getting
Yeah,
adjustable rates.
I mean, so yeah, I've been doing this for 11 years, and I've never done this many arms. I mean, it's just
Yeah.
this is like a perfect environment for an arm. But if people don't, a lot of people don't like to take risks, especially first time home buyers. So if there's not much of a difference, like let's say a 5-year arm is only a quarter lower than a 30-year fix, then just stick with the fixed rate. And if rates go lower, great, just refinance later on into another fixed product. That's probably the biggest reason I would say is if rates are already low and you're already like, let's say under 3%, there's not a huge difference. Just go the 30-year fixed. Also, if you just don't want to take on risk, right? Like if you just don't want to, like, you can't sleep at
Yeah.
night, think about this
Yeah.
adjustable
Yeah.
rate mortgage, don't do it.
I was gonna say I do investing obviously, and I have like several balloon payments, like six month term type loans that I'm sure a lot of people the risk level wouldn't be there, but some people have a comfortable risk tolerance for different properties. Let's talk about the pros of an adjustable rate mortgage. So basically, obviously it's going to be a lower interest rate, and the interest rate's also capped. So some people are like, okay, you get an adjustable rate and then the rates go up significantly, let's say after 5 years, but they can only go up so much. If you have an adjustable rate mortgage, you can't go up like 10%.
Yeah, so the way it works is most arms, like there's the first adjustment period. Let's say you're doing a 5-year arm, right? So it's
Mhm.
fixed for the first 5 years. On the first adjustment, usually it can only go up or down by 2%. So like worst case, let's say I lock you in at like 5%.
Okay.
The worst case on the first adjustment, it could be 7%. Like that's if rates are much higher than they are right now. And then
Mhm.
again, the second adjustment can be usually it's capped at 5% over. So if you're at 5% on a 5-year arm, 5% on the second adjustment, in total it can't go higher than 10%. So you're capped at like 10% in that situation.
Okay. So yeah, so always check with your lender as far as like the caps and stuff like that. But some people don't realize like the interest rate could also go down. You can get adjust. Everyone thinks it's automatically going to go up, but it could go down, which
Yeah, 100%. Yeah, that we've saw that, like, where rates for pretty much, when I first started in 2011 till like 2021, rates were, pretty much going down, every other year. And some people that had arms just stuck with them because their rate kept adjusting down, so they never even had to refinance into a 30-year fix. So yeah, there's another benefit there. If rates go lower, you just stick with the arm. Although I
Yeah.
probably wouldn't recommend that. Like if it makes sense at some point, you should probably just refinance to a fixed rate, if you plan on owning the property for a longer period of time.
Okay. And then as far as like the cons of an adjustable rate mortgage, prepayment penalties. I guess there's prepayment penalties with some of these arms, right?
Not really. I mean, most arms, at least that we have, I'm sure there are
Mhm.
some out there. They have prepayment penalties, but most arms don't have prepayment penalties anymore. That was like back in 2005,
Okay.
2008. There were some option arm products that would have prepayment penalties. Those don't really exist anymore. So yeah, I wouldn't really worry about that piece. You definitely check with your lender to make
Yeah.
sure. Yeah, another con would be just rates, adjust higher, right?
Mhm.
And you don't have the opportunity to refinance out of it, and you're just stuck with a higher rate. And those are situations you just want to plan for worst case. So, if you're okay with like a worst case scenario, and you also want to try and figure out what's the probability of that happening. It's hard to really figure that out, but
Mhm.
usually it's pretty low. Like if you think you're either going to sell the house within the first 5 or 7 years, if you think you can refinance, or if you think rates will be lower, it can adjust lower. So like, what are the odds of it adjusting much higher? It's probably on the lower end. So um, just
Okay.
that's probably the worst case scenario. Is just you hold on to the house, the arm adjusts higher, and you're stuck with it for a little bit.
Yeah, and maybe like, let's say 5 or 7 years from now, theoretically you'd be making more money, so you'd be in a better position. But there's a chance maybe you have, several kids, and maybe you got downsized from work or whatnot, and there's more payments, so that there could be a little bit more risk, with that. What types of loans can you do an arm with? Pretty much all of them, right?
Yeah, so I mean, the most common is just like a conventional loan or like a jumbo, which are like loan amounts over 970,000. There's some pretty good jumbo arms out there. Those are the most common, but there are the government loans are FHA and VA. There are
Mhm.
arms out there. They're not that attractive. At least I haven't
Okay.
seen them. Apparently, there's going to be some good arm products coming out that I've, at least from talking to management, in the near future. But
Mhm.
FHA and VA, they have them, but they're not attractive. So most people are just sticking with the 30-year fixed on those loan products.
Okay, got it. And just a quick reminder, if you're watching this and you're looking to purchase a property, Alex and I are in the DC area. I'm an agent and investor. Alex is a lender and investor. Definitely reach out to us. And even if you're in, nationwide, we pretty much have resources and recommendations and referrals to different agents and lenders, pretty much nationwide. So definitely reach out to us. All right. What do most people at the end of an adjustable rate mortgage? What do most people do? Do they sell, refinance?
Yeah, it's hard to say. I mean, everyone has their own situation that they're kind of stuck in. Like if you're, let's say the adjustable at the end of an adjustable rate mortgage. Do you mean after like the fixed rate
Yeah.
period?
So yeah, yeah.
You're
So
asking.
let's say like it's a
Um,
five. Let's say it's a 5 year arm. The 5 years is up. They're like, okay, do we sell? Do we just keep it going with the new adjustable? With the new
Yeah.
rate?
So if it's after the fixed rate period, and you got to figure, okay, is it adjusting higher or lower?
Mhm.
Is my plan to like rent this place out? Am I positive cash flow? Am I negative cash flow? And then you figure out, does it make sense or not to keep it? If it's an investment property and you're not netting that much money, and you could just sell it and take the proceeds and put it elsewhere, right, in a different investment property that may make you some money. Um, but yeah, most people aren't really caught in that situation. I would say most people are able to refinance out of the arms. But some people do get stuck in an arm and maybe just adjust much higher. You just got to figure out like what situation you're in, right? It's
Yeah.
hard to really say like
Yeah.
what's the most
Everyone's
common.
going to be different. You should reach out to your lender, have them like give you a few options so you can think about it, and that
Yeah,
type
and
of.
then another thing is, maybe after, let's say you're in a 7-year arm and your balance is much lower at that point, and maybe you could refi into like a 15-year fix, because 15-year
Right.
fixed are lower rates too.
Hmm.
And then you could pay it off in 15 years. Like that's another situation I've seen before, where I've done that for people. So it really just depends.
Okay. All right. As far as like qualifying for an adjustable rate mortgage, is it any tougher than qualifying for like a standard conventional or
Yeah, I
fixed
mean, the
rate?
only situation like where it is much tougher is for a 5-year arm, because we have to qualify 2% over the start rate. So
Because
even
you
though
have to
your
do
rate,
the worst case scenario, basically, if the interest rates were to go up.
yeah,
Right.
well, so like the worst case situation would be 5% over, but on a
Okay.
5-year arm, like almost every product out there requires, like, say you're locked in at 5% on a 5-year arm, we
Mhm.
would we would count the payment at 7% in terms of our debt to income ratio, right? So it can be harder to qualify for a 5-year arm. For a 7-year arm, we can qualify you off of the start rate. So if your 7-year arms at 5%, we would qualify you at 5% too.
Okay.
So really, the 5-year arm, I would say, is the only product. And then sometimes some of these arms do require a little bit more money down. Like the good products we have, like we have one that's requires 10% down. We have
Okay.
another one that requires 20% down. And then we have another pretty strong arm at 5%, but really just depends. I've done all three this year.
Okay.
Um, and so I would say down payment, and then on the 5-year arm, just we would have to use 2% over the start rate to qualify you. So those are the two main items for these
Okay. And
qualifying.
so basically the more you put down, the better rate you could potentially get.
Potentially, yeah. I mean, it really depends, because sometimes this 5% down option has slightly lower rates than even the 10% down. It
Mhm.
just depends. Like the rates kind of move around. So I just figure out like what product's best for my client, show them all the options, and let them make a decision on what works for them.
Okay, cool. Anything else we need to add about adjustable rate mortgages?
I think we covered most of it. Just make sure you talk to multiple lenders. I would say, like, if you are shopping, and I'd be happy to help anyone out there that's looking locally or even
Yeah.
elsewhere, because I have a lot of connections.
Okay, perfect. We'll put our contact info below. If you're looking for a good real estate agent team, reach out to myself. Good lender, reach out to Alex, and we'll see you on the next video.